YouTube, what it do? It's your boy Young Soros here back with another video, and today we're going to be talking about the bond market and how if things keep progressing the way they are, then we can see an economic disaster go on within our economy, and we're also going to be going over how we could be potentially seeing not a recession, a depression. So drop a like if you enjoy. Make sure you comment, subscribe down below, and let's jump right into it. Starting with the 10-year bond. They have not been this high since 2000 since 2000. And in 2000 we had the dot-com bubble and the 2000 recession, so not looking good there, not looking good there. The bonds are as high as they were last year when inflation was at almost 10%. So again, not very good. They're also higher than the banking crisis that we had this year, even though the bonds are higher than this level right here where the banks collapse. The banks have not collapsed yet, which is very interesting considering all the things going on. And as time goes on, we will see that are the banks really that sturdy, or will the dominoes start to fall as we go into Japan? Japan is actually selling our bonds and increasing their own yields as inflation is starting to come back into their economy slowly but surely. And their bonds are actually each reaching 10-year highs. So as time goes on, these things will start to impact and hurt the economy as well as things around the world, as well as Europe, China. And China has been a leading indicator within this for the entire year. I mean, go look at China's charts. China is right now experiencing deflation, and deflation is not good for any economy over an extended period of time. You'll end up with how China experienced, not China, Japan, how they experience a lost decade. China might go into a lost decade. So that is a scenario we could be potentially looking at. Will it get that bad? Who's to say what's in the future? But there are definitely leading indicators that will give us a guidance into that direction. UK bonds also hitting highs of last year. Now, granted, the UK bonds are at Liz Truss levels where she decided to change policy, and then she decided, okay, we're gonna stimulate the economy and then go back and forth and almost break our economic system. So the bonds are at those levels. If they hold and go back up and start running up even higher, over to 5% possibly, then things are definitely gonna break within the UK, and that can cause contagion across the world. And next thing you know, we're in a recession. But for now, we're just going to take it easy and take it slow. For now, the bonds are calming down as Powell hasn't really said too much from his last meeting at Jackson Hole. He didn't give us no guidance, which calmed down the bonds a little bit. But we have to see what's going to happen. Now, as we take a look at the 10 year is usually a pretty good indicator as to what is happening in our economy. It is an economic barometer that economists use and people use to determine how good or bad our economy is going and what is happening within the financial markets. Usually, if rates are low, that means our economy is doing pretty well for itself depending on the situation. As you can see in 2020 when COVID happened, the Fed cut rates to damn near zero to stimulate our economy because our economy was falling apart and everything got stopped, halted, things like that. So they had to give out money and cut rates to stimulate the economy, and in doing so, they boosted our economy. And if you take a look at the stock market right now, if you take a look at the markets now, from when the Fed cut rates all the way to now, that is a substantial move. So the Fed cutting rates and putting money into the economy is gave the stock market a huge boost, but it also gave a disadvantage to people holding bonds because they're getting less than 1% off of 10 years, which is very bad. So it made people go from risk off assets to more risk on assets. Uh, but for the most part, when the Fed cuts rates, it's usually during a recession or before a recession. And they do that so that way there's two reasons why the Fed cuts. Either they're too late to the problem and they're trying to provide the cuts as an airbag, or they cut rates the anticipating that the crash is already started and they're trying to blunt the blow a little bit. But doing doing so and cutting the rates early, if you're fighting inflation like we're doing now, the Fed can't cut rates early, or else inflation will come back up again, and then they're gonna have to raise rates higher than they are currently, and then they would have to cut them from an even higher rate. So depending on where you are and what's going on in your economy, having low rates is not always a good thing. But if your rates are on the rise like this, like inflation in 1980, then that is a very bad sign for your economy. You usually want your bonds to be stable, but for the most part, if your bonds are rocketing higher and going at insane insane volatility in the bond market, then that is not good for your economy. As we take a look into the yield curve, a very good predictor of recessions is the inverted yield curve, meaning that the 1 month and the 10 month are inverted, aka the 1 month being higher in yield than the 10-year yield. And you may think to yourself, why would 1 month yield me more than 10 months? Well, it's because people think that right now 1 month is going to be safer than 10 years and vice versa. These should be inverted. Well, these should be flipped. The 10 years should be at 5% and the 1 month should be at 4% in a healthy economy and an uninverted yield curve. But because the uninversion of the yield curve is happening, people are saying that short term things are not looking so good as compared to longer term. So they will try to get more yield for their money short term than longer term. And when this happens, you get an inverted yield curve. Now, an inverted yield curve usually predicts recessions almost guaranteed. Are there some times where the yield curve inverts and there is no recession? Yes. But for the most part, it is a 99% that if you get to inversion, there is a recession. Now, when there is an inversion, this is where most people get misunderstandings. When there is an inversion with the yield curve, that doesn't mean the recession is there just yet. There is a lag between the inversion and when the recession starts, as well as the yield curve uninverting and going back to uninversion. Meaning that if the yield curve inverts and uninverts really quickly, our recession could be 6 months away or 12 months away. But but if the yield curve inverts and stays inverted for an extended period amount of time, you might not see the recession play out until it uninverts again. So you just got to be careful when looking at the yield curve and things like that. They are very accurate in predicting recessions, but depending on what you're looking at, you may be wrong in terms of when you might want to time you playing the bonds. So keep that in mind as we move forward and we see the bonds start moving and things like that. But usually, the deeper the yield curve inversion is, more severe the recession. And as you can see, we are way lower than 2000 and 2006. So keep that in mind as we move forward. And in 2006, you had the yield curve invert and then uninvert in 2007, and then you had a recession in '08. So you just gotta be. All right, now as we take a look at to the money supply, now the money supply tells us how much money is in circulation within our economy. So a lot of money in circulation within our economy, that is great. That means our economy is thriving. People are taking people are spending, people are have money in their bank accounts, people feel wealthy, all this other stuff. But as the money supply shrinks and goes negative, then that means people don't have money in their bank accounts and all these things. And usually that is an indicator of a recession when our money supply shrinks. And our money supply right now sits around 3.5. That is almost as low as the Great Depression. That's actually lower. It is lower than the Great Depression. Our money supply currently is lower than the Great Depression. So, looking at this, you may think to yourself, but times are different. Things don't. All this other stuff. And there's a saying in the financial world: everybody says this time it's different until it isn't. So usually everybody says all this time is different, just like how they said it was different in '08, just like how they said it was different in 2000, just like they said it was different in 1980. Everybody in the investment world says it's different until these things happen. And once these things happen, you then start to realize that it's not that different. The signs are all right in front of us and we just aren't seeing it. Now, what can you do with this information? Well, you can start preparing now by saving your money, investing it into bonds, or even buying real assets like gold. But for the most part, but for the most part, um, you take a look at. But again, take this with a grain of salt, even though this is very alarming for our economy and things like that. They were going through an extreme outlier period of record growth and then record deflation. But if you take a look at the chart over here, we had a record growth too, and we had record, yeah. So very eerily similar, but at the same time, just because all these things are happening within the economy, that doesn't mean the recession is affecting the stock market. As you can see, it's almost at all-time highs. So you can invest and make money in a bull market, bear market, doesn't matter. As long as you know what you need to do to navigate the markets and maneuver your way, whether that be through bonds or whether that be through the market. It's all about knowing what you can do and what outcomes can happen depending on what economic factors come out. And sometimes the market just chooses to ignore the economic factors while the bonds may react, or the bonds may not react to economic factors, and then the market may react. So just keep that in mind as we go forward into as we end this year and going forward into next year. We're going into very bearish months. September, October, usually very bearish, but towards the end of the month, November, December, um, they're actually in favor of the bulls. So we will see what happens. There's a lot of data coming out this week, and data is going to be more important now than it has been in a while because Powell, once again, he came out and said nothing. He just read the same script that he's been reading for the past 6 months. So, with that being said, data is going to be more important, whether that be coming from China, Japan, here, UK. Data is going to be important. And if one data set is too hot or too cold, it could shift the market and the bonds. And once we start seeing the market and the bonds move very violently, we could get another scene like this and start watching fireworks happening. And maybe potentially 2024, 2025, we break this low here. I don't think this is the actual bottom just yet. The macro economic environment and the macro factors are just too bearish for me to say that we might hit all-time highs. It is just too much that is not in our favor, especially in the stock market. If the rates stay this high for this long, the market isn't going to be able to even hang on, especially if they decide that they might raise rates higher. And depending on if they raise rates higher, the stock market is definitely not going to like that, as you can see the reaction from 2022. So keep all that in mind as you go forward into next year. And next year in 2025 is definitely going to be some fireworks, as that's when I feel like all the macro data and the macro factors of the economy are starting to come together and show us the bigger picture. And from there, we will get a glimpse of what is going on. But that is the end of this video. Drop a like, comment, and subscribe down below if you enjoyed, and make sure you subscribe if you do. It's your boy Young Soros. Peace out.